Hi, everyone. We're now looking at yet another category of adjustment. We're looking at a partial acquisition, but importantly, this is on a different acquisition date. So my reporting date is different from the acquisition date, and we'll see basically how are these, adjustments. Something called as a pre-acquisition share of profits and the post-acquisition share of profits, which now comes into the picture, and we'll see how does it actually work. Now, this is a typical adjustment which is there in the examination most of the time. So we need to be very, very comfortable around it. It says that X acquired 80% shares in Y on 31st of December 20. The balance sheet on 31st of March 21. So the acquisition basically has happened, 3 months prior to the reporting date, right? All the information about assets, liabilities, etc. are provided, but also it is said that the retained earnings of company Y on 31st of December 2020 is given as 25,000 and the NCI is measured at fair value. Also, there is one more adjustment which we want to bring along. It says that would your answer be different if NCI is measured under proportion of net assets method, right? So there are several adjustments that we want to take together, but let's focus on the method of NCI under the fair value method. So we'll be using that, and then we'll simply make the adjustments for the NCI if it's taken at for example under the proportionate method, right? The proportion of net assets method. Okay. In this scenario, what I would like to do is basically I want you to be very comfortable around this relationship. The relationship between the entities, and that's where we see the first change coming in. My date of acquisition, which is 31st of December 20, and my reporting date is 31st of March 21. Percentage holding is 80%. So we have a subsidiary in place. Okay. Now, the other working that we want to do is, it's again not very typical question. So we look at the goodwill on the acquisition date, right? So this is my purchase consideration. I can simply pick up that value, which is 2,40,000 less net assets. Now, importantly, you want to remember this is something which is done on the date of acquisition. So we need the net assets information on the date of acquisition, not on the reporting date. Okay. So what you want to remember here is you want to keep the share capital as it is, which is 1,50,000. But your retained earnings to be used are 25,000 rupees. Okay. So the retained earnings are 25,000. Now this gives me my total assets. Please bear in mind, this is all on the acquisition date. This is 1,75,000. Then I will make the adjustment for the non-controlling interest, which is given to me at fair value, which is 50,000 rupees, right? That simply means that I'm paying 2,40,000 for something worth 125, resulting in a goodwill of 115,000, right? That's the first adjustment that we see. You're taking the retained earnings and the share capital as on the date of acquisition to calculate that goodwill. That's a very straightforward exercise. Now, since there is a difference between the reporting date and the date of acquisition, we also want to do an additional working, which is about your retained earnings now, right? Or if there were any elements of equity, we would do it for the same. But then this is the way we want to kind of go ahead. Okay. We look at both the company X and company Y, and we are saying, what are the retained earnings, for example, as per the question. Okay. And we have provided that information. It is 1,20,000 and 50,000 respectively. Right? And then we are saying out of this 50,000, which is the retained earnings of the company Y, as per the question, we want to remove the pre-acquisition earnings, right? Which is basically the same figure as this amount, right? The purpose is very simple, very straightforward. This amount of 25,000 represents my post-acquisition earnings, right? And now we want to split this 25,000 between how much is the share of the parent company, that is 80%, and how much is the share of NCI, which is 20%. Okay, we need to bring this 80% here in the column of company X, and this total would give me group retained earnings, right? So this 1,40,000 becomes my group retained earnings. NCI's share, of course, will be added in the NCI's value itself. Okay, that 5,000 will come over there. Okay, so the entire objective of doing this working is to arrive at the group retained earnings there. Okay, let's also do, by the way, there is also another working that we want to do now, because there is a movement, there is a change in the value of the non-controlling interest, which we're simply saying is the opening balance that we are provided with, which is of course this value of 50,000. This is the same value of the non-controlling interest on the date of acquisition, plus share of company Y's profits, which is calculated under working 3, that is 5,000, which means that my closing balance is 55,000 here. Okay, and now we are in a comfortable position to prepare our consolidated balance sheet. Okay, consolidated balance sheet of company X as at 31st of March 21, right? We again use the same format. Assets, non-current assets, wherein we have property, plant and equipment, 1 lakh plus 2,50,000. Now that gives us 3,50,000. Okay, then we have license of 30,000. We also have had goodwill under the working 2 that we calculated of 1,15,000. Okay, and then we have the current assets, which is inventories, 40,000 plus 30,000, making it 70,000. Cash and cash equivalents, 50 plus 20. That's another 70,000. Other current assets, 20 plus 25. That makes it 45,000. This would give me total assets in the column. Let's do the calculation, which is 350 plus 30 plus 115 plus 70 plus 70 plus 45. This gives us 6,80,000 rupees. Okay. We want to also do the calculations on the other side, which is, of course, your equity and liabilities. We start with the equity, parent's equity again, share capital of the parent, which is 2,40,000. Retained earnings, you want to recollect that we did that working number 3, group retained earnings of 1,40,000 will come. Okay, that's the reason why this is important. And of course, we have now non-controlling interest, which is working number 4 for 55,000 rupees. Okay, and then we have non-current liabilities. Okay, bank loan, simple numbers, 50 plus 100, 1,50,000. Okay, deferred tax, which is 30 plus 5, that is 35,000. Okay, and then we have current liabilities as well. This would be payables of 15 plus 10, and then we have other current liabilities of 25 plus 10. That makes it 35,000. And now we can simply do the total equity and liabilities calculation. Now this would be 240 plus 140 plus 150 plus 35 plus 25 plus 35 plus, of course, that 55 remaining. That gives us 6,80,000. So that is something that we wanted to match, and it certainly matches as far as the total assets amount is concerned. Okay, so what you want to remember here is that in case your acquisition date and the date of reporting are different, then we have more calculations to do. We need to calculate the goodwill, of course, on the acquisition date. We need to also look at the retained earnings, split that between pre and post, right? And then the post acquisition profits or the post acquisition earnings need to be divided between the parent and the NCI. Okay, and then we look at, of course, the calculation of non-controlling interest, and then we bring all these numbers together at one place in the balance sheet. All right, there's also a second part of the question which says that would your answer be different if the NCI is measured under proportion of net assets method? Now, what do you want to recollect? We did this discussion under the business combinations accounting standard as well, where we calculated the NCI. There are 2 ways to calculate that. So the second method would simply want us to calculate NCI, right? So we're looking at, of course, if measured at proportion of net assets, right? We want to build that. So we are simply saying my net assets on the date of acquisition right? We had this information where we had the share capital, right? And of course, the retained earnings, right? The share capital of 1,50,000 and retained earnings of 25,000, making it 1,75,000, right? And then we are saying the NCI as a proportion at the rate of 20% of these net assets, right? Now this gives me a value of 35,000 there, okay? Right? Now the NCI simply calculated 35,000, which means that the goodwill and closing balance of NCI will change to the extent of the difference, right? Of course, we remember NCI at fair value is provided at 50,000, but NCI as proportion of net assets is measured at 35,000. So this would create, to that extent of the difference, it would create the difference in the value of the goodwill. And of course, the closing balance of NCI would also change to that effect there, right? That's how you start looking at the change in the answer. Everything else, the property, plant, equipment, licenses, inventories, cash equivalents, other current assets, bank loan, deferred tax, payables, other current liabilities, they do not change. They do not change at all because NCI does not impact any of these, right? The parent continues to control those values the way they appear. All right. That's something that you want to keep in mind when you look at calculation of these numbers as a part of the question. All right. Thank you very much.